love the nicety. Bring your own flag, a Mexican flag there on show. There's only one thing to think about, and it's sporting euphoria. As yields rise, equities still manage to trade higher. Two-year yields at the bottom of your screen are the highest since the middle of December. We're above 5,000. It is Super Bowl weekend. What is not to love about this Friday? We're rolling over to the cash market. You've got the NASDAQ up 0.25% again. Palantir trading on the upside. So this is quite a bullish start to this Friday countdown to the open. There we go. Flat on the dollar, euro, and yields, as I say, on the 10 years. They're trading just up 3 ticks. We moved higher by about 15 ticks, and still it has not dislocated the equity market rally, and that's the important point. You are just seeing 2- and 5-year yields at the highest level since December the 13th, and that was just before the revisions, but yields tick higher. Crude trades up 1%. We put on 6%, nearly 6% this week. There's your 2-year yields at the bottom of the screen, 4.48. Let's stick with one of the stocks. PepsiCo, the company delivering a disappointing outlook amid weakening volumes in North America. Katie Greifield is with me. Katie.
Manis, yeah, full-year sales, that forecast did disappoint, but it was really the drop in volume that's turning heads this morning. To get specific, volume in North American beverage business, that was down 6%. Quaker Foods North America volume down 8%. And PepsiCo's revenue overall was $27.9 billion in the fourth quarter. That was below the average analyst estimate. And this is really potentially a sign of the times. We're talking about earlier how Hermes still has pricing power. It looks like PepsiCo might have reached its limit. Remember, over the past several years, the company has consistently raised prices to offset those higher input costs that the company was having to deal with. That has helped PepsiCo beat on profit and revenue consistently over the last few quarters. Now it seems like that strategy may be sputtering here, and that's a reality that the company itself acknowledged in this earnings report. The CFO saying that consumers can now expect to see a slowdown in price increases. It's interesting to watch how the market is receiving this news. Shares currently down about 2%.
Katie, thank you very much. Let's stick with the earnings track. Pinterest shares under pressure, missing the holiday revenue estimates. Ed Ludlow joins me from San Francisco. So again, another bruising for Pinterest. We saw some snap action earlier in the week. Take it away, Ed.
Yeah, I mean, we're down more than 10% at the open. That puts it on track for its biggest drop since April of last year, I think, but it is not as severe as the knee-jerk we got in after hours when the numbers hit. Top line growth of 12%, $981 million of sales in the quarter gone, but below the expectations of the street. And what's so interesting here is, similarly to Snap, they showed some user growth, users reaching 498 million monthly users, which is a record high for them. The concern is their conversion, right, and the strategy behind how they reach an audience on behalf of advertisers. Let's play the game of is Manis or is Manis not on any given social media platform, but like my use of Pinterest has been, for example, around when I plan my wedding with my wife. You bit up storyboards. What Bill Reddy, the CEO, has done is said, how do we take that concept on the platform and convert it into transactions? In other words, direct response ads. Direct response ads, when he took the helm, were about 1/3 of their business. Now it's 2/3. But it's not necessarily materializing as the top line growth that the street expects. One piece of standout news as we continue to be down 9.5% is that they announced a partnership with Google. Similar to what they've done in the past with Amazon, the idea being that if you are faced as a consumer with a picture, you have a way to click through, resulting in a transaction down the road. And the partnership with Google is substantive because through Google's shopping platform and search, it gives Pinterest an audience that's global, not just in North America. Not getting a lot of love though, down 9.5%.
Now look, Ed, we just had a little bit of breaking news come through. This is through X and BetMGM. They're going to sign a sporting partnership. So this is an interesting sort of side shift for the X brand. BetMGM, each game linking to BetMGM's website. Talk me through this. What's the rationale here?
Just think about X as a distribution platform. that is how all of the sales and ad executives working at the company are pitching this, right? So it appears in the timeline tied to Super Bowl Sunday, but it can get redirected to that third party, which in this case is BetMGM. It's a traffic provider. There is so much news coming out from X this morning. We're actually going to speak to their head of partnerships in the 10 o'clock hour, so tune in for that, Brett White's. But the other piece of news that Bloomberg's reporting is they're out there right now shopping ad slots for the Super Bowl, ranging from the kind of hundreds of millions to the hundred thousands to millions for small increments. And they have this partnership with WWE. What you're starting to see is X reposition itself from text to different forms of content, but they're doing it through partnerships where there's a kind of ad share or revenue split concept with the third parties with which you sign deals. That was a lot, but I hope it makes sense.
Yeah, no, it does. I mean, it's about progress and evolution of what is the X platform, and it is obviously a multimedia platform which is engaged in sports. It's huge. And by the way, they've said that major professional and college sports will follow in weeks to come. So again, it's about building momentum in terms of the generations. Ed, thank you very much. Deftly handled. We'll also be watching the shares of Affirm. The buy now, pay later company is forecasting less than expected as questions arise about how long consumers post-pandemic spending spree can really last. Isabel Lee is with me. Isabel.
Hi, Manus. Shares of Manus are now flat, actually edging slightly into green. In pre-market trading, it was down as much as 9% and also just a few seconds ago. But analysts said that the guidance was conservative because they're not seeing a slowdown in the second quarter. The buy now and pay later firm expects the forecast of gross merchandise volume to be lower than consensus estimates for the year. But the thing is, in the recent quarter, in the second fiscal quarter, they did top estimates. In fact, we have the CEO saying that this is the fastest growth pace in over a year. So there's that. But now shares are kind of flat, up about 0.4%. Affirm raked in a total revenue of around $591 million, which is above estimates. They also had the revenue less transaction costs rising 68% a year earlier. So the firm also increased its funding capacity by around $5 billion in the last year. So this buy now, pay later firms really benefited from the revenge spending that we've seen after the pandemic. Everyone just wanted to buy things because they were cooped up in their apartments for most of the past 2 years. But we know that consumers are resilient, but the question is, how much further can they go? So that remains to be seen, Manus.
Indeed. Isabel, thank you very much. Isabel Lee there. Tune into our conversation a little bit later on with the Affirm CEO, Max Levchin. That is at 11:30 a.m. Eastern. How long can the hedonism of the U.S. consumer endure? Turn to travel. Expedia shakes up the leadership with the CEO change along with missing estimates on gross bookings. Emily Greyfay joins me now. Emily, what can you tell me? I mean, a shift at the top, but it is about the bottom line numbers that we really want to focus.
That's right, Manus. And that shift in leadership, the CEO now going to be Ariane Gorin. She'll be succeeding Peter Kern as Expedia CEO. That really came as a surprise to analysts. And I think that's really what is driving this stock down now 17% at the open. The earnings that they reported yesterday really weren't that bad. The fourth quarter revenue beat slightly, and so did the fourth quarter EPS, coming in at $1.72 versus $1.69. Fourth quarter gross bookings missed estimates slightly, coming in at $21.67 billion versus estimates of $22 billion. But really, it does seem like the street here is more focused on that leadership change. According to Bloomberg Intelligence, it could signal a really lack of strategic direction here. Over at Jefferies, they cut their price target to 150 from 160, saying that the CEO change and also Expedia's reduced guidance has really lowered Jefferies' confidence in Expedia's turnaround. We also saw Bank of America cutting to neutral from buy. So not a great morning for this travel company, Manus.
No, it could be just another warning shot across the exuberant buys of the equity market. Emily, thank you very much. Invesco's Brian Levitt weighs in on what to expect this year. Get ready. The market is likely to go higher over the next 1 to 2 years, if not longer. Peak inflation, peak tightening, peak interest rates have historically been good for equities over the subsequent years. There's nothing can stop the train for Brian Levitt. Brian, good morning to you. Expedia down 18%, Snap down 30%, advertising under pressure. I mean, I could look at one half of the glass, but you're looking at the other half of the glass getting ready for a top-up. Why are you so bullish?
I think it's a two different environments. So in the short term, you're going to see the economy slow, and that's what's weighing on earnings a little bit. That's what we wanted, right? That's what the Federal Reserve was trying to bring forward. So the economy slows a little. You get a little bit more of a concentrated market, and maybe the market a little bit more challenged in the near term. But my point is to say, think over the next couple of years. If you look at just about any environment where we've had inflation move up significantly, once it's peaked, not when it gets back to 2%, once it's peaked, the next multiple years have historically been good for equities. That's been my North Star. It has worked very nicely since inflation peaked in June 2022 and continues to be my view.
Pretty stoic equity markets. I caught myself short. 2-year and 5-year paper at the highest level since the middle of December. And, this equity market has gone on to evolve even higher. New records, record all-time highs for the S&P 500. Now, can that lockstep prevail with higher yields and higher equity markets? That is not a marriage made in heaven.
Well, we're recalibrating a little bit. So you saw a very broad market in November and December on the result of investors believing the Fed funds rate was going to 3.75. And now we're backing that out a bit, which is why you've seen, for the most part, small and mid caps underperform the mega cap growth names. That's less healthy, as we both know. And so my point again is to say that I would expect that you may see some more of a defensive shift in these markets, a little bit more challenge in the near term. But over the intermediate term, rates are going lower as this economy slows and as the Fed eases. And that finally gets us out of what's been a bizarre COVID environment and gets us on to, call it a mid-cycle slowdown that we emerge out of.
I'm just looking at this backup in yields, and I just wonder to what extent do you incrementally pick that up? I've just opened the Bank of America Flow Show. Flows gravitate to IG and high yield over government bonds. And again, this goes back to the narrative. If we're going into a cutting cycle, why not pick up a little bit of IG and high yield? Is that how you differentiate? Are you more driven to credit than you are to bond, than you are to sovereign?
Yeah, over the next couple of years, credit should outperform, again, because we should have a mid-cycle slowdown and emerge out of it. And the early stages of that recovery should be very beneficial to corporate bonds. I think that the challenge investors have right now is they love money market. And they love money market because the yields are attractive and the historical volatility is low. And they're not feeling the reinvestment risk to the extent that we thought they may have, because to your point, rates are backing up a little bit. My opinion, that's not going to last forever. This Fed will ultimately normalize this yield curve, which means money market investors have a reinvestment risk. And I would say, lock in yields where you can. Fundamentals in the corporate space look quite attractive.
I mean, I would just qualify, I'm just looking down here at the rest of the lines. High-grade funds recorded another significant inflow last week, the 14th inflow in a row, and the largest since June 2020. Are there any flags that talk? I mean, lots of people this week have talked about concentration risk, over-concentration in Mag 7. Here you go, 14 weeks in a row into high yield. It feels pretty maxed out for risk, but you say no menace to any drawdowns, buy into them. It's a strong market, strong world, embrace it.
Yes, that's what I feel. There's very little excess in the economy. There's not a substantial amount of leverage. Business borrowing's actually been moderating on a year over year. So it's the Fed eases and these markets are going to want to go higher.
I love what you say. We escalated quickly. It was a Ron Burgundy moment, but you were disappointed. I think it's brilliant. I mean, it's amazing the things I wade through when I get ready to go on a show. It was as Ron Burgundy would say, it felt as if it all sort of went really, really quickly, and you're just disappointed that there's not more breadth. So why not weigh in on the breadth to Mag 7 argument? Have your say, Brian.
Yeah, I mean, I would have hoped that small and mid-cap rally would have lasted a lot of 2024. You got the whole 2024 outlook before the year even started, and now you have a market that's recalibrating where rates are going, ironically recalibrating rates higher. Ultimately, I think it's an economy that slows. This is what we've been trying to get, and in a slower economy, you get a bit more concentration. The other side of that is easier policy, a recovery trade, and broader market participation. As I've said 100 times, I'm a FOMO guy. I don't want to miss out on that. And my expectation is over the next couple of years, a broader market that I want to participate in.
Listen, I'm with you 100% on the FOMO. Weaponized FOMO is the line of 2023. Let's see, it is turning into that 2024. Brian, thank you very much. Brian Levitt on the markets. Coming up on the show, President Biden attempting to alleviate his memory concerns.
I'm well-meaning, and I'm an elderly man, and I know what the hell I'm doing. I've been president. I put this country back on its feet.
That conversation ahead on Bloomberg.
I'm well-meaning, and I'm an elderly man, and I know what the hell I'm doing. I've been president. I put this country back on its feet. My memory is fine. My memory, take a look at what I've done since I become president. None of you thought I could pass any of the things I got passed. How'd that happen? You know, I guess I just forgot what was going on. I'm the most qualified person in this country to be president of the United States and finish the job I started.
Finishing the job he started, President Biden pushing back, defending himself after the DOJ report labelled him, quote, an elderly man with a poor memory. However, during the response, Biden mistakenly confused the Egyptian president with the leader of Mexico. Meanwhile, his likely rival, presidential rival that is, Donald Trump, moved one step closer to the GOP nomination after securing a win in Nevada caucuses. Kayleigh Lyons is with us. Kayleigh, thank you very much for coming in for this. I mean, when you see the presentation, the body language, and even the sound of the president yesterday, he's quite vexed.
Yeah, he was incredibly upset with the characterization of his memory in this report. He did say that he was glad that the report found that he did not commit any crime here, noting the differences between the classified documents investigation into Biden and Trump, keeping in mind here that the special counsel, Robert Hur, did not actually charge Biden with anything, though did note that he willfully retained classified documents after leaving office. The key distinction that the special counsel made was that in the Trump case, which he said he doesn't necessarily have a right to comment on, he was also charged with obstruction. The former President Donald Trump was, not just the willful retention of national security information, noting that President Biden and his team cooperated fully with this investigation. He said that that was a key distinction. Donald Trump, though, on the other hand, says that this is just evidence of a two-tiered system of justice and unconstitutional selective prosecution, so it could feed into that political narrative. And of course, the other political narrative, perhaps the bigger problem for President Biden this morning, is it feeds into the narrative that there is an issue with his mental acuity and his age at 81 years old, and that he cannot serve a second term in office because of the language in this report. Things like the special counsel saying he could not remember key years in which he was serving as vice president, even the year that his son Beau died, which upset the president greatly. Those kind of lines in the report already have been seized upon by Republicans, by Republican campaign arms like the RNC, as evidence that Biden should not be elected to a second term. And that is something, frankly, that the president can't change. He's 81. There is nothing they can do to spin that. The gaffe like last night saying that the president of Egypt, President al-Sisi, was the president of Mexico, didn't do much to turn that narrative around.
Well, yeah, and the slightest mistake or misspeak or misstep is grabbed upon on both sides. Kayleigh, where are we with Trump? Because he wins the Nevada Republican caucus. So what does this do for the evolution for the ticket?
Well, it doesn't much change the narrative we already thought, which is that Trump right now is looking like he will be the Republican nominee come July when the convention is held. In Nevada, it's worth keeping in mind that he did win the caucus. The caucus was the only chance to actually pick up the state's delegates because of a very confusing system. There was a primary 2 days ago where Nikki Haley was on the ballot. Trump was not, but she had no opportunity to win delegates because of the Republican Party of Nevada's rules around this contest, and also lost to the selection on the ballot none of these candidates. So it was pretty bruising optically for her. Trump will now walk away from Nevada with all of the delegates in hand, and we'll look ahead to the next contest 2 weeks from tomorrow is the South Carolina primary on February 24th in Nikki Haley's home state where she served as governor. She is still lagging behind him significantly in polls in that state. And so right now it does not look like Nikki Haley has a real opportunity to eat into Trump's lead at this point. But of course, we'll look to Super Tuesday where there are 11 states that also have open or semi-open primaries where she could try to gain some traction. She certainly still has the money behind her. Donations are still pouring into her campaign, but Donald Trump is far and away the front runner, is picking up far more delegates as we go along.
Well, it certainly looks as if the theater is set to take place in South Carolina, isn't it? Doesn't look like she's stepping back anytime soon. But then, of course, that is what a shock and awe is all about in politics. Kayleigh, thank you very much. Kayleigh Lyons, tracking the political stories from Washington. For some sector price action, let's get back to Katie Greifeld.
A quick look here. You take a look at the S&P 500, just slightly higher. You have 5 sectors in the green right now. Big tech and energy hand in hand, pushing this index higher. Big tech leading the way. They're up 0.6%. You do have 6 sectors in the red right now, and that is led by consumer staples. That group down about 0.8%. A lot of those losses coming, of course, from Pepsi with that disappointing earnings report dragging that sector down. But overall, we're pretty much an even split, and we are above 5,000, Manus.
The magic number. Katie, thank you very much. Coming up, we'll set the events for you to watch. It's counting down to CPI on Tuesday. It's a hazy daisy day in New York, but we are over the 5,000 level. That's important. Nothing can stop this equity market at the moment, even rising bond yields to levels that we haven't seen since last autumn. There's the Russell even coming up, the Nasdaq up a third of 1%. Some tech on Palantir is rising. It's Super Bowl weekend. I know that you wanted me to say that. Let's see what's in your trading diary. We've got Super Bowl in the diary. Well, we've got a bit of Fed speak first of all. Dallas Fed President Laurie Logan speaks at 1:30 Eastern. And you got it. Sunday it is the Kansas City Chiefs versus the San Francisco 49ers in the Super Bowl. Pay to play on the advert slots. And we get the CPI data on Tuesday. Plus Coca-Cola report earnings before the opening. Just tracking Pepsi. Will they disappoint? Thursday retail sales. That was countdown to the open. We're back on Monday morning. Good morning from New York.
Minutes into the U.S. trading day on this Friday, February 9th. Here are the top stories we're following. Finally there, the S&P 500 finally crosses 5,000. Everyone cheers, but what's next? We'll discuss. And X pushes into video, the social media platform teaming up with WWE to launch a new weekly series. X's head of partnerships joins to discuss the strategy. And finally, supply chain check. How is turmoil in the Red Sea spilling over to warehouses and trucking? DHL supply chain CEO Oscar de Bach offers his perspective in just a bit. I'm Katie Greifeld in New York. Welcome to Bloomberg Markets. You take a look at these markets right now, and there's a lot to celebrate. We're not talking about huge gains here on the S&P 500, just about 0.3%, but we are above 5,000. Never have seen that level before until today. Well, for a moment yesterday, but we're not going to talk about that. Let's also talk, though, about big tech. The NASDAQ 100 up 0.5% or so. Of course, big tech continuing to lead this market higher as volatility pretty much flat. I mean, you look at the VIX right now, below 13, these gains coming on the back of volatility continuing to leave this market. And that's even though, of course, we are in the heart of earnings season. Bloomberg's Emily Grafeo joins us now.
Well, hi, Katie. I'm looking at Expedia because the earnings weren't that great for that company, and they're also facing a CEO switch up. They announced this morning that Arian Gorin will succeed Peter Kern as the CEO, and this came as a surprise to Wall Street. Bloomberg Intelligence said that it signals a lack of strategic direction for the travel company. We also saw Jefferies cutting their price target on Expedia to $150 a share versus $160. Bank of America also cut to neutral from buy. Overall, when you look at the earnings, they weren't that bad. The EPS was actually a slight beat. The revenue was also a slight beat, but what did miss was the fourth quarter gross bookings, which missed estimates just slightly, coming in at $21.67 billion versus estimates of $22 billion. But yes, overall, that stock moved today.
It's interesting to try to weigh out what the bigger disappointment was here, whether it was the CEO change or that bookings miss. Of course, a combination of both there. But I'm really excited to talk about Pepsi and Hermes because it seems like this is a tale of two different levels of pricing power at this point.
Yeah, it absolutely is. When you look at Pepsi, that stock was hitting the worst move since October, and that's really an idea here of Pepsi has been trying to raise their prices, and for a while it was working. The company seemed to be proving that they had pricing power, that consumers were able to kind of stomach the higher prices for a number of different consumer goods and packaged foods, but now it seems like that is starting to dissipate just a little bit with their growth forecast coming in worse than estimates. But then you look at Hermes, a completely different company that caters to the ultra-rich, and they've seemed to be able to kind of weather this economic storm here. They actually replaced L'Oreal today in French trading as the second most valuable company in France, and that stock was up 7%. Hermes has this model of scarcity. You can't just go in and buy their ultra luxury handbags, the Birkin. You kind of have to buy a lot of other products before you can actually get on the list to buy the Birkin. So this is completely different than PepsiCo, but that stock and those earnings were much better than expectations.
Yeah, it's interesting there. Of course, Birkin's hard to get their hands on. You take a look at the details of the Pepsi volume decrease. Quaker Foods, a 10% decline in volume. Analysts had been looking for a 3.8% decline, so I guess people aren't buying oatmeal. Emily Grafeo, thank you so much. And for more on these markets right now, I'm pleased to say that we're joined by Nancy Tengler. She is CEO and CIO over at Laffer Tengler Investments. And Nancy, I'm thrilled to have you with us because from a young age, we're told to worship at the altar of diversification. And I love this line in your notes. You write that most portfolio managers over-diversify because they lack conviction, some spice there. What is the optimal number of stocks that one should have in their portfolio?
Well, I've been running, hi Katie, thanks so much for having me. I've been running concentrated portfolios since the mid-90s, and the optimal number, according to research, but also my experience, tends to be about 12 names. And that allows you to get some diversification across sectors, but we actually, our portfolio is called our 12 Best Ideas portfolio, and it's comprised of the companies that we think have the greatest earnings growth potential. Obviously, we want to buy them when the valuations are attractive, or at least attractive on a growth at a reasonable price basis. And then we want to hold them until we think the secular narrative behind their growth is done. So we're looking for catalysts, we're looking for great management teams, and it's worked out pretty well for our clients.
So it's worked out well, but does that outperformance come at the cost of underperformance in bad markets? For example, a year like 2022, when the S&P 500 was down 19%, how does that ultra concentration fare?
Well, because we have a growth bias, it did worse than the S&P, better than the NASDAQ. And then last year it was up about 41%, better than the S&P, not as good as the NASDAQ. So it's a little bit more volatile than our other portfolios. But actually, when looked at over a long period of time, it pops up into the top deciles of relevant peer groups, which, by the way, is hard to find. So I think you have to have risk tolerance to be in 12 names. But over the long term, it ends up generating better than index returns as long as you can handle volatility.
So when you look at the portfolio right now, and I have to say 12 names, that is so small. Really cool to see that kind of conviction. Where is your conviction right now? What names do you like?
Yeah, so we're overweight technology. The portfolio is about 45% in technology. We have Palo Alto Networks, ServiceNow, Microsoft, Broadcom, and we're actually looking at adding another name in the coming weeks in the tech space. But then our other big overweight is consumer discretionary. And then we're sort of, spread out between old economy names that we think are pivoting to digitization and generative AI, cloud computing. And those are in sort of more conservative sectors. And that's really our investing theme across all of our strategies. We want managements that are pivoting. I mean, think Spotify, moving Joe Rogan's exclusivity, getting rid of it, and then allowing the podcast to get ad sale on other platforms, sharing that with the talent. We think that's a great move for Spotify, and those are the kinds of things we're looking for the company.
I got to say, I'm very curious to hear what that tech company that you're going to add is. Maybe you can tell us in a couple of weeks' time. But that's really interesting, your comments when it comes to the old economy names, that you're looking for those that are trying to tap into AI and some of those tech investments. Because looking across the list that you shared with us, it really spans sectors. But it sounds like that's the common thread.
That is the thread, Katie. And I think it's a very important one. Like you get a day like today, a company like Pepsi, which we own in our relative value dividend growth strategy. And we bought that name because the company identified as a tech company that happens to sell beverages and snacks. And so we're going to be interested to see how they expand margins now that the pricing power is gone. And if they can't, then we're gone. So that's what we're looking for in the old economy names.
Yeah, that's that pricing power story. Maybe we're at the limit when it comes to some of these names who've been raising prices for quite a while. But an interesting feature of this earnings season is that you take a look at the month of February, a lot of buybacks. Bloomberg News actually crunched the numbers, and U.S. companies announced over $100 billion in planned buybacks in the first 7 days of February. That is more so than the full month tally in January. It's also the strongest start to a February ever. What signal are you taking away from that all of these companies are coming out with these big-time buybacks?
Well, I mean, they've got a lot of cash. I think what we learned from higher for longer from the Fed was that it actually benefited the big technology companies. So think of Microsoft that started, I think it was second quarter of last year, with about $500 billion in cash on the balance sheet, but they were earning double what they'd earned previously. And at the end of the third quarter, certainly some of that was, earnings growth or earnings that went to the balance sheet or went to cash, but they're at 1.3 billion. So, I've drawn an analogy between this market and this economy to the 1990s when, I was not only alive, but I was managing billions of dollars of other people's money. And what's really set that in line was not just that that was when share buybacks really became a thing, when they enter the shadow banking system. That phrase was coined by Paul McCulley. And what you have is large public funds and insurance companies that have an insatiable appetite for debt. And we saw it again in February. Now we've got a bill that was passed in Congress where they'll be able to write off 100% of interest expense. And so expect to see more of this, and it will put a floor under the market. I mean, I'm not a big fan of buybacks, but they do drive stock prices. I'd rather see the companies add dividends as Meta did, or increase their dividends as many of the companies have done. So right. we have been talking about this, that this is going to place a floor, and so you buy the dips in this environment, and at least for now.
Well, I'm glad you brought up dividends because like you mentioned, I mean, Meta coming out with its first ever quarterly dividend. You think about dividend stocks, and maybe this says more about me than anything else, but I think some of those old economy names that you were talking about, it seems like the profile of these dividend paying companies may be starting to shift.
I think so, Katie. I mean, it happened in a previous wave with Microsoft and Apple, and that's actually when we got into the names. It tended to be historically a signal that growth was over. And so when growth companies initiated a dividend, there was this general feeling that they couldn't grow anymore and they didn't have anything better to do with their cash. I don't think that's the case here, and I'm glad to see it. We saw an announcement from Disney that after they reinitiated their dividend, they're going to raise it again very significantly in July. So I think that is a trend that will continue. I've been arguing or asking for a dividend for Google for about 2-3 years, and I haven't fallen on deaf ears. But I do think you want to pay attention to the free cash flow of these companies, like an Amazon, that's going to be generating in a couple of years $100 billion in free cash flow. They're going to have to buy back shares and hopefully also initiate a dividend.
All right, Nancy, got to leave it there. Always enjoy speaking with you. Have a great weekend. That is Nancy Tengler, CEO and CIO of Laffer Tengler Investments. Now coming up, X is teaming up with the WWE for an exclusive weekly series. We speak to Brett White, ex-head of partnerships and talents, on the deal next. This is Bloomberg. Well, X is getting into the ring with wrestling entertainment giant WWE. The exclusive series called WWE Speed will debut on the social media platform this spring. And I'm thrilled to say that joining us now is Brett White, ex-head of partnerships and talent, as well as Bloomberg Technology co-host Ed Ludlow. Ed, kick us off.
Yeah, Brett, welcome to the program. It's good to have some time with you. I mean, this is the next step, right, in the X platform becoming more video focused. And I think I understand the deal, right? WWE produces the content, you guys are the distribution platform, and then there's an element of revenue share. So I guess as a starting point, have you started selling ads against this new WWE product?
Thank you guys first for having me, Edward and Kate. This is great. We couldn't be more excited, obviously, about the new initiative that we're doing with WWE. We announced the partnership yesterday. We are in market here in the next, call it 5 days. with assets to start selling the show. We've got a lot of interest. X is what I would say the home for wrestling fans. We're going to go very big when it comes to what this offering is. The idea of catering to an audience. Last year alone, we had 59 billion impressions when it came to wrestling alone. So the idea that we can actually super serve this incredible content to an audience that is there, that is vibrant and waiting for it, couldn't be more exciting for us. So we are ready to go and in market.
When does this turn profitable? How many of these types of partnerships do you need to really make money off of this?
That's a great question. I mean, it really is, when we worked with Nick Khan and his team trying to figure out exactly what the mechanics are financially, we're going to be playing these episodes once or twice a week on X. They're going to be on platform for in perpetuity, honestly. And we'll start making money, over the course of the year. We'll see how the financials actually work out. But the investment that we're making in the content really is, at some point will become profitable, probably in the next couple of years.
I think, there's been a lot of news this morning coming out of X. You also have the Super Bowl and bet-related stuff. But just lay out the partnership strategy. Your job title is Head of Partnerships and Talent.
Yeah.
What verticals do you expect to move into? Your background's in wrestling over at Turner and other things. But there is a difference here between pure sports, live entertainment, and then you're doing a lot in news as well.
We are. And so I got here, thank you, Edward. When I got here 4 months ago, I really kind of went on a listening tour and trying to figure out exactly kind of what the audience was looking for, what consumers wanted. And it is news, it's entertainment, it's fashion, it is sports, and it is wrestling. And so when we look at the portfolio, we have an incredible relationship with all of our sports partnerships, whether that be NFL, MLB, NBA, a multitude. We have 1,000 publishers through our Amplify business. We have 80,000 content creators. We're going to continue to build out a great content partnership business, but also start to serve original contents to an audience that we believe is worthy of and wanting it. So when we went after Don Lemon and Tulsi Gabbard and Jim Rome, we really knew that as we build out this kind of bespoke content, this is exactly what the audience and the consumers on X are looking for.
And how have these past partnerships, of course, that you've already signed up, how have they driven subscriber growth? Is that translating already into advertising revenue?
So not yet. So we have obviously Tucker on platform, and he's been on for a while. He's doing fantastic, and Paris Hilton's been there for the last few months. But we are in April. We'll start seeing Jim Rome's original series will start to premiere. Tulsi's shows will start to premiere, and then in the next kind of 3 weeks to a month, Don will premiere the Don Lemon Show exclusively on X. So we haven't been in market yet with actual original content. But once they hit the airwaves, then we'll start to see some revenue trickling in.
Brett, I think a criticism or a lack of understanding when it comes to X is the conversion rate of how many users see a video which is attached as a post, and then how many people actually end up watching it. So let's take the Tucker Carlson and Putin example, right? The post shows, let's say, 100 million views of that post. What proportion or ratio of any given post actually materializes as tangible views of a video? And as you know, a view can be 0.1 seconds, or you can retain a viewer for several minutes. Just explain the data and the science there.
Yeah, so I can give you more about, the data and the science kind of would go to somebody who actually understands the data and the science much better than I do. But when it comes to the actual stay time and the engagement time, that's what we're seeing, which is beyond. It's incredible. And the Putin interview from yesterday has shown incredible engagement. We're seeing it continue to grow in numbers. We're seeing it. There's the conversation not only just on X but on post replies and shares, but also on other platforms. And that's what we're seeing is like X becomes the hub of content creation and culture defining moments, and then they start to trickle out into other different platforms as well. So we're really starting to see through our live and our original content offerings incredible attribution to not only the X platform, but how it trickles throughout other platforms as well.
Well, Brett, as you continue to push into video and you build out the content, how will this actually look on the app? If I open it up on my phone or on my desktop, for example, will there actually be a tab, or how will I find all of these videos?
Yeah, it's a great question, Katie. So last week we announced that there's going to be the creation of a video tab on platform, which is really going to be our hub for original content. As of now, obviously a lot of our stuff is being posted through handles and through takeovers, but you're going to start to see a much bigger push towards the media tab, the video tab on X. That's going to be the true destination for our content strategy, and I think that's going to be the transformative moment as people start to come to the platform for video first. And so as people prior used to tell stories through text, we're now starting to see, obviously, stories and conversations happening more in video, and you're seeing that across all platforms.
It's so interesting to compare what you've announced with WWE, which is a weekly short-form series, right, relative to the Super Bowl, a live event. You know, historically, that was Twitter, their bread and butter. Live events, yes. People get talking. You're in Vegas. I'm sure you're meeting with a lot of partners and advertisers. You know, what are your expectations for the ad deals you can do around a live event like Super Bowl?
Oh man, we are seeing incredible engagement around advertising on Platform for X. We're seeing a huge increase from year over year engagement when it comes to the NFL. We're seeing incredible engagement when it comes to the advertisers that are on. We have, you know, this is a completely new offering on X. Don't think of this as legacy. This is a completely new business with new priorities, and so we're seeing kind of a 70% increase in spend when it comes to the advertisers that are there. We're seeing incredible attribution. I don't know for you guys, but this is the first time in my life where my daughters have actually been engaged in a Super Bowl and cared about the outcome and who's going to be there. So it really is, we're starting to see cultural moments, which is what X is obviously it is the central focus of when it comes to a global audience. It is about cultural moments and bringing people together for a conversation.
Well, Katie and I have been pretty busy, Brett, in our roles as chief wrestling correspondents in recent weeks. So we're moving from wrestling to Super Bowl. It will be a big focus of my show. I mean, let's go to the Everything app to end. You have this betting arrangement that you announced this morning. You know, where does that fit in your work with partnerships? Because as far as I can tell, again, you act as the distribution platform, but the benefit to the partner is you're redirecting traffic to their site. Is that correct?
It is. So we are, you know, think of us now as we build out this Everything app. This is really where we're bringing people right into the action. I call it like a virtual sports book, whether that's in your pocket, whether that's in your home or your garage. You're really bringing people into the action in real time. And we want people to have more and more at their fingertips. I mean, it is about coming into the experience and staying around for a multitude of different experiences, whether that be, you know, video and voice calling, whether it be our content initiatives, whether that be payment, obviously, as you know, is a big initiative for us as we push forward. So these are just different verticals that we continue to build on the app as we iterate and innovate going forward.
All right, that's a good place to leave it. Really enjoyed this conversation. Brett Weitz of X, and of course,
thank you both.
Bloomberg's Ed Ludlow. Now, still ahead, we'll take a look at the companies making the most social buzz today. That's Social Climbers, up next. This is Bloomberg.
experts, great questions.
All right, time now for Social Climbers. Look at the stocks making waves on social media this morning. First up, L'Oreal getting lashed by investors after missing earnings estimates. The French beauty brand pointing to a decline in shopping by Chinese travelers. Next up, Take-Two slashing full-year forecast below estimates thanks to a softening in mobile ads, disappointing revenue from its new game, NBA 2K 2024. And finally, Children's Place hiring an advisor to evaluate how it can boost cash reserves. Kitty Apparel Company has been running out of money in a challenging environment. Of course, you can follow all of this on TREN Go on your Bloomberg terminal. Now coming up, we'll get a read on the global supply chain. We're going to do that with Oscar DeBach, DHL Supply Chain CEO, joins us next. This is Bloomberg.
What is really unclear today is the situation is unfolding. It's still actually in an escalation phase. So we have rejigged our network completely, sailing everything south of the Cape of Good Hope, and expect to do that for a while until we have really safe passage reopened in the Red Sea. So this could be with us for a while.
And that was Vincent Clerc, Maersk CEO, speaking to Bloomberg TV yesterday, warning worse is yet to come when it comes to the Red Sea. And let's get the boots on the ground view of disruptions in global supply chains, because here with us now, I'm pleased to say, we have Oscar DeBach, DHL Supply Chain CEO. Oscar, it's great to have you with me. So not commenting specifically on what's going on in ocean and air, which I know that you're not involved in, but what has the spillover been from the Red Sea to your business?
Yeah, I think what it actually the impact that it has, we manage the supply chain for our customers, and obviously what you see is we need to help our customers to find alternative ways to get the goods to the market. And on the one hand, you have obviously the delays because of the way ships sailing, but on the other hand, you need to find different modes of transport. And some customers we move to air freight, some customers we actually move even to the combination of intermodal and ships. So there's various modes that we have to find. At the same time, we have to also, together with our customers, really look at how you store. So that's another element. But I think overall, what it really reconfirms once more is a point that I often make, which is what I call omni-sourcing, which basically means that when you look at global supply chains since the past 3-4 years, companies, many of our customers, have to rethink on how you organize your supply chain. And you can't simply base it on one point of source for a strategic part or product. You have to have more source points. And that's actually what you see happening at the moment in the overall supply chain market.
Well, I definitely want to get to that topic of nearshoring, adding multiple, of course, sources there, like you say. But when it comes to the Red Sea, you talk about the contingency plan that your customers are putting in place. How long are they preparing for? When it comes to this turmoil, what is the base case that they're baking in for how long this could last?
Yeah, it's a lot of guesswork, but I think and that's the main point, I think, with managing supply chains in today's world is you have to work with various scenarios, and you have to create an agile and flexible solution. And because there's theories that this will take for a longer time. There's ways where you can say, well, maybe for a part I need to have alternative modes of transport, like I was mentioning earlier, going for intermodal, air, etc. So for how long they perceive that this is going to take, many of our customers think that this is for quite a while still there, and at least you have to plan accordingly, so in order not to fall short on stock in the near season, in the upcoming seasons. Because if you make a simple count, it takes 10 days extra, as you know, with the present route around the Cape. That actually means that you have to up your stock levels in order to cope with that. So that is something that you now need to plan ahead, or you say, well, if I take that part of it, I might actually use alternative ways of transport in order to cover that part. Now, that depends very much on the type of products and the type of sectors. I read this morning that even in the fashion sector from Bangladesh, you see more flights out now actually in order to cover that with air freight, which is obviously not a solution you would normally think of. So you see that there's various alternatives that are being used by our customers at the moment to find solutions both for the very short term, but also look at the mid and the long term to have a sustainable solution that can also cover what's next to come in supply chain disruption.
Well, like you said, a lot of guesswork there, but obviously with some big important implications when it comes to bottom lines. Let's also talk a little bit more, though, about nearshoring and, of course, that trend. Like you said, a lot of companies looking for different points to which they can source from. What countries, what regions have been the biggest beneficiary of that?
Yeah, you see a lot of, and I always call it, instead of nearshoring, I call it omni-sourcing, because many of our customers would make sure that they don't gamble on one point, but at more than one point to always have alternatives. But to answer your question on which geographies do we see that most on, now, obviously we very much see it in Mexico. If you look at even yesterday we opened a large new facility, at least we break ground on a large new facility in Mexico, and it's one of many of which we see a lot of take, obviously many investments that go in that direction. But apart from Mexico, you also see big investments going in countries like Malaysia, where you see specifically on the semicon industry, you see major investments going to that direction. We see a lot of things happening in Vietnam, but also a market like India is fast changing its trade, similar to what we see in Brazil.
And I do also want to talk about China. Of course, China also looming large in this conversation around supply chains. And so far this earnings season, I mean, just today we heard from L'Oreal talking about sluggish demand from Chinese consumers. How are you seeing China's sluggish economy, sluggish recovery turning up in your business?
Yeah, I think China is obviously, well, for us, it is very much about helping our customers to find a solution. But obviously, you see that the volumes are different from what they used to be. But on the other hand, the Chinese economy remains a very important one. So therefore, our customers remain very much focused on China. But indeed, there is a bit of guesswork on how fast will that catch up. We're going to see a little bit after this weekend of Chinese New Year, how then the volumes are going to be over there. So it is also there. It is you have to balance it between the midterm view and what's happening today and yesterday. And I think that's very much what's happening at the moment, because it remains a very important market. You need to be ready. You need to be there. You need to continue to invest in that market, and that's what you see our customers are doing. But it is a bit of patience on what is really happening on the short term there.
Absolutely. Yeah, that's a conversation that companies across industries are having right now. I do want to talk about warehouses. Of course, I don't need to tell you that the real estate market for warehouse properties, it was extremely tight during the pandemic. Where do we stand now, both when it comes to prices and availability of some of those properties?
Yeah, you see an interesting development in real estate, because you see that there's less volume being developed at the moment. While at the same time complexities of supply chains continues to evolve. So we're fast therefore heading towards a scarcity of capacity also there still pretty soon. So that's, for instance, why we continue to make our investments in specifically logistics real estate, and also because there's more and more requirements to go closer to the end consumer, and so therefore the whole profile of where warehouses and logistics centers or fulfillment centers, whatever name you want to give it, but where they need to be. They need to be more and more closer to urban areas. So there's two trends. On the one hand, less development happening at the moment, which means that there is an indication of scarcity coming up. And at the same time, there's different locations where actually logistics centers are needed because of, specifically if I look at the US market, because we need to be closer to the end consumer.
And Oscar, just quickly here, what about wages? Are warehouse worker wages still going up?
Yeah, you've seen obviously, I think we had the biggest part of that season because over the past 2 years you had a major scarcity in labor. That is settling in at the moment, so that is sort of stabilizing more on that perspective. I think the biggest hurdle on that one we've seen already. But I think on the other hand, it remains always a challenge with availability, and that's where I think you also see the balance between staffing and robotic solutions, digital collaborative robotic solutions. If I take for instance ourselves, last high season we had investment in less number of people while we were doing similar volumes, but because of the investments in robotic solutions that we've done there. So you see the collaborative robotics is also helping out on the scarcity of labor, and at the same time the labor market is sort of settling in, so that pressure is getting less.
Well, we're going to have a bigger conversation on that relationship hopefully soon. Oscar, really enjoyed this. That, of course, is Oscar de Bach of DHL Supply Chain. And let's get a quick check on these markets right now. You look at the S&P 500. We are green, up about 0.3%. Big tech leading the way, though. The NASDAQ 100 up about 0.7%. It's quiet in the bond market, only up about 2 basis points or so on 10-year Treasury yields, and the VIX, just for fun. It doesn't do much, but I like to look at it. Currently below 13 right now. Now coming up, the history of presidential elections as told by the markets. Scott Besson of Key Square Capital says that U.S. equities are already seeing a Trump rally. That Wall Street votes conversation up next. This is Bloomberg.